All right. Welcome, everyone, to the ClearVista Financial Perspectives February 2024 market update. Thanks for joining us. Glad you're here. We'll go ahead and get started. I'm Mark Trice, financial advisor, joined in the studio today by Jesse Hamilton, also a fellow financial advisor. Excuse me.
Hey, everybody. Welcome. We'll get started in just a second.
All right. Let's go ahead and jump in, Jesse.
Perfect.
Right.
So here's our agenda for today. We'll discuss our index performance, just like we normally do for the major indexes in January so far this year. And we'll make our comments on the markets, and we'll also talk about the state of the economy. We'll talk about what happened yesterday with the Fed and maybe what we can expect to see in 2024, although we don't have a crystal ball. Of course, we have our new and improved way of interacting with you. We would love to hear from you today.
Yeah, the easiest way to do that is to text us at 254-282-0495. Even if you're watching or recording this, if you have a question, you can send us that text. You can also send us an email to info@clearvistafinancial.com. We'll make our best efforts to answer those at the end of the program. So we'd love to hear from you.
Yeah, we'd love that. Let's go ahead and turn the camera off just so they have a little more room.
Sure.
But we'll get started here with the S&P 500. So this is our, for those of you who have not joined us before, and as a reminder, this is called a candle chart. It's what we use every day to follow the markets. Red candles are down days and green candles are up days. But first off here is, of course, the S&P. That's our large cap index. It was up 1.58% in the month of January, and it had a gradual rise until the end of the month. You can see the last day right there is a red candle. We'll talk about what happened. There were a handful of new highs, which is very interesting. We'll cover that in a few slides coming up. But very interesting month here. Gradual rise is nice for those of you that were participating in large caps. But let's talk about some more volatility here. Next up is the NASDAQ. This is our tech-heavy, also cap-weighted index. It tends to be heavily influenced by the 7 largest companies in the US, and it also tends to be a little bit more volatile than the S&P. It had a pretty choppy rise through the month, and overall it was down 2.23% yesterday, even though the month closed plus 0.98%. We will talk about the Fed meeting in just a moment about what happened there. Wanted to note that it's still more than 6% away from its previous high, which is very interesting. We'll look at all the previous highs in just a moment.
So the NASDAQ hasn't recovered fully.
That's right.
And that we'll talk about that in a minute. I think what's to note here is that we really didn't have traditional Santa Claus rally at the end of the December.
Mm-hmm.
And that choppiness continued on through the month of January. And so we ended up in the major indices up for the NASDAQ and the S&P 500, but not much of a move.
That's right. So next we'll cover small caps through the Russell 2000 index. These are just a look at the small caps in the US. The index fell 3.9% in January. Quite a choppy sell-off and then a slight rise in the last week of the month. And really, Mark, unfortunately, this is not what we were hoping for in January.
Right. We were really hoping that the Russell 2000 would continue, well, would begin to lead large caps. That would signal a very healthy, broad-based rally in the markets. And we did not see that. So that's unfortunate that we not see that. That gives us some additional cloudy signals for the future. We're not sure exactly which way the market's going to go.
Yeah. We'll talk about why this is an important relationship. Lastly, our index here is the long-term treasury, and that index was down 2.25% in January. You can see the last 3 trading days of the month, it rebounded slightly. But this is, of course, inversely related to the interest rate environment.
Yes, it's supposed to be inverse or contrarian to the stock market. the last few days of the month were actually negative for the stock market overall. And so that could have been a flight to safety. It could have been reaction to falling interest rates
Right.
on hopes that the Federal Reserve was going to cut interest rates this week,
Yeah,
which they did not.
We say that it's inversely correlated, but this index obviously moved over 2.5% this month, and the rates are the exact same.
Yeah.
You can see the kind of the light blue line in the middle of the chart there is the 200-day moving average. That's a significant long-term indicator of strength.
And we're flirting with it. We haven't surpassed that yet, have we? Or have we? Yeah, we have. Yeah.
Just barely.
Just barely, right. Okay. And of course, our disclosures we need to give and share with everybody.
Yep.
Take a moment to read these thoroughly. We use indices as for discussion purposes. It's not something we recommend that people invest in by any means. You can't really buy the index as it pertains to the S&P 500. I thought it was interesting, Jesse, as people read this slide. I did a little bit of research myself this last weekend, and what I noted is that of the 500 components on the S&P 500, 500 companies, only 345 of those companies are still below their all-time highs.
Okay.
Yeah,
that's quite a few.
Yeah, it is, and that tells you, that's almost 2/3.
Over 2/3.
Over 2/3 of the individual companies on the S&P 500 are still below their all-time highs from back in 21 and 22. And so we're still seeing continued weakness. And here's another reason why.
Yeah, so here's a 2.5-year look back. The S&P 500 is in red and green, like we're used to, and the Russell 2000, the small cap index, is in blue. I've updated it to show the last little piece there is January. You can't really tell because I wanted to show the entire picture, but notice how in 2021, the blue line is above the red-green line.
That's right. That was coming out of the pandemic. And then the small caps were having a very strong year. They actually were outperforming the large cap companies, but they were actually in 21, were actually moving sideways. But it's still, they were much stronger than the large cap companies.
So about 10 months ago, they stopped cooperating and moving at the same pace. And really the small caps started to underperform the large caps. And you can see last year, they kind of tracked together, but there's a gap. There's some white space in between the two indexes. And what we really need to see is the blue line surpass the red and green line.
So small caps need to begin to lead the way in order for a very healthy, broad-based recovery in the market to maintain itself.
So all this chart is the comparison between large and small caps. So this is kind of a different way to look at it. When this is trending up, that means large caps are winning, and when it's trending down, that means small caps are winning. And you can see who the winner was for most of last year, right until the end of the year.
Yeah. So is this trend changing? Maybe so, but we haven't seen that really in the last few weeks.
Right. So this shows the S&P 500 equal weight index, which is something we always like to look at. It's the same 500 companies, but each company gets an equal vote versus the regular index, which is cap weighted. The big companies have all the power.
So how would we describe that to people if they're comparing it to, I think comparing it to Congress is an easy way to understand.
Yeah, it's basically the House of Representatives versus the Senate, where states have one vote or two votes each, right?
In the Senate.
And then the House is based on the size of the population.
Right. So it's weighted based on the size of the state. So the S&P 500 index is what we call cap weighted. And then the equal weighted index is each company gets one vote.
So I've drawn a black box here around what we call a trading range. And I did expand it just a little bit to include the price action for the end of the year. But as you can see, we've been bouncing around between highs and lows for almost 3 years.
And have not set any new highs. We'll talk about that later in the program today.
So here's a chart that shows the percentage of stocks above their 200-day moving average, which, as we said before, is a sign of strength. Generally, we want to see this as a sign of bullishness. And I just wanted to point out how quickly we moved with this indicator. The left side, you'll see it's kind of low. That's around 24%. and then it very quickly rose to the middle of the chart there. The peak is around 65% in 2 months. That's a
Yeah,
very dramatic
it was a
shift.
very rapid change, and we still we like that because it shows that the market may be improving on a very quick basis, but it hasn't continued to move up. In fact, it's been trending down since really the end of December.
Right.
So there's still a lot of uncertainty in the market of what's going on.
The right side of that chart is January, and you can kind of see how it's just moved sideways.
Yeah. Okay.
So here at ClearVista, we base a lot of our market analysis on the rank and performance of the 11 sectors of the stock market. So I don't normally show this picture because I have to block out a lot of things for compliance reasons. We don't want to show any individual tickers or anything. So I apologize that the picture looks messy, but what I'm trying to show here is that red stoplights signal weakness and green stoplights signal strength. You can see the top performers. I took this picture yesterday are communication, financials, healthcare, and technology. And the worst performers are discretionary, real estate, materials, and industrials.
Okay. So these are just now these sectors rotate in terms of their position in the rank.
That's right.
Every day. So we just look at this to see what sectors are beginning to outperform others.
Yeah.
Not that it's a decision we make to buy or sell anything. It's just we're looking to see who's in the pole position, if you will.
Yeah. It's kind of one more comment there, Mark. It's kind of interesting to show the ambiguity we're dealing with right now. Technology is right up at the top alongside healthcare and staples,
which are defensive. Those two are defensive sectors, where tech is going to be a growth sector. So we're getting lots of different mixed signals.
So last slide here before we shift into the macroeconomic data. This is a compilation of some of the major indexes we've talked about and how far they are from their previous high. We've talked about the NASDAQ, 6% roughly since its last peak all the way in November of 2021.
Yeah.
The S&P actually has recovered. It's since then pulled back from that high. The long-term treasury, of course, is the most painful one, minus 38% still.
And this is what a lot of near to retirement, new to retirement folks are holding in their portfolios for like a 401k or something like that. If you're in that age bracket where you're thinking about retirement soon, or you just went into retirement and you don't work with us, you need to look at that portfolio because the bonds have been dragging down the performance of the overall portfolio. And I should note here, Jesse, with the S&P 500, because we'll get lots of calls from clients, and they'll say, "Well, I'm reading the news that the S&P has hit all-time highs."
Yeah.
And they're thinking, well, why is my portfolio not hitting all-time highs? And the reality is that is one index. We've said earlier, Jesse, that you said this, that it's dominated by the largest 7 companies cap weighted in the country. And I shared earlier that over 2/3 of the companies in the S&P 500 still have not retraced to their previous highs.
Right. So if you have 100% of your portfolio in cap weighted large caps, congratulations, you're at an all-time high. But that's not how people invest.
And really you should be careful about that, because you're probably over leveraged, over risked in your portfolio if that doesn't align with you to take that high risk.
Yeah.
So the moderate portfolio index, Jesse, was what?
I'll show a visualization of this at the end of the presentation, but it's essentially flat for the year. And it's still 9.8, almost 10% off of its previous high. And this is what's really frustrating to a lot of investors.
Right. So if you've not seen your portfolio move, or it's still down, this could be an explanation why. This is a moderate portfolio is going to be a mix of stocks and bonds, almost equal weighted. I wouldn't call it balanced, but almost equal parts stocks and bonds.
Yeah.
And then this year to date for the month of January, you said equal weighted S&P 500 was?
It's slightly down 0.85%, and it's over 5% off of its high.
Okay. All right. So let's just jump through and start talking about the macroeconomic outlook. Okay. Reminder, folks, you can send your questions or text them to 254-282-0495, and we'll get back to you hopefully on the program, if not within 24 hours.
Yep.
Let's start talking about the economy and the interest rate environment.
So what happened yesterday with the Fed?
Well, as you can see here in the picture,
Mr.
Chairman
Powell.
Jerome Powell, or Uncle Jerome, as we affectionately call him, is looking up in the air, looking for answers because he doesn't have them. We're being facetious, of course, but the Federal Reserve met this week to make an official decision on interest rates. Now, their decision, which was unanimous, was to hold rates steady and remain cautious moving forward about when to cut. The market increase from October through really now has been based on the assumption that the Federal Reserve investors have been baking in the assumption that the Federal Reserve is going to cut rates any moment now.
Right.
And they were hoping for some to yesterday.
They didn't get it.
They didn't get it. And so their reaction really was, as far as the market, was less than bullish. Some indexes sold off by more than 2%.
The NASDAQ did.
The NASDAQ did yesterday. And so it just creates a state of unknown, continued unknown, as we await some sort of change. In fact, we watch the press conference that the chairman does, and we look at how it's moving the markets. Now, the press conference for the Fed started right around 2 o'clock, where I'm moving my cursor over here.
This is a minute chart, by the way.
This is a minute chart of the S&P. Going good for the first 15 minutes. He just simply reading the press statement that everybody has already read.
Yeah.
And then he starts answering questions. Now, the first couple of questions.
Answering questions right at 2:30.
Right at 2:30, and the first couple of questions he answered correctly.
Yeah.
For investors, he answered correctly, and that seems that they're thinking about rate cuts any day now, right?
So what happened at 2:45?
2:45 is when the good reporters actually ask good questions. And almost immediately, Chairman Powell said something to the effect of, "No, we don't know when we're going to cut rates." And the market said, "Oh, that's not too good. We're going to get out of the market." Now, we do this, and in fact, it's a policy in our office. We do not trade any portfolio's during the time that the Federal Reserve is having a press conference.
It's just not prudent for the clients,
because it's purely an emotional gut reaction,
right,
based on nothing more than emotion, that moves the market during these times. And so we think that the Fed is, and they said this, the Federal Reserve is waiting on more data to justify their decision. He did talk about core inflation, which is a little bit different than the CPI index that people see. Core inflation is below 2%, which is their target, but it was 1 month.
Right.
And so they're waiting for confirmation of those things. Will they raise rates in March? Chairman Powell said not so likely. He didn't say no.
To cut or raise?
To cut.
Okay.
I think the language in their statement this time was that they're done with their rate hike cycle right now.
Okay.
The cutting part is what remains to be seen. It's going to cause some volatility in the market for the next several months. But we do think that they're waiting and seeing what's going to go on with the economy.
Okay.
Jobs reports come out tomorrow on February 2nd. They'll be looking for the CPI data, which comes in the middle of the month, and to see if there's any change. If it stays below, will the inflation stay below 2%, or will it begin to tick up again? They're trying to avoid a repeat of the 1980s, when they cut rates too quickly and began to see inflation tick up again.
So we got GDP data in January for the fourth quarter of 2023. The real GDP increased at a 3.3% annual rate,
which was unexpected.
It was unexpected.
If the economy needs to cool down in order for the Fed to cut rates, it's not happening. And
it beat the consensus significantly.
It beat the consensus of all the economists. It also, job report came out later on that it beat the estimates for number of new jobs.
We're counting on personal consumption for most of this growth.
Yeah, and that was really the kind of the, people were still spending money.
People are spending a lot of money, whether they have it or not.
Now, I don't think this is seasonally adjusted, because we all know we spend a lot of money buying gifts for people during the November, December timeframe.
Mm-hmm.
But, we like to focus on that core GDP, which include consumer spending, businesses and their fixed investment spending, home building, and it excludes government purchases, because if you include the government in there, you really can skew things, especially when they're sending out stimulus checks. So
It's still increased though.
yeah, all those things are usually typically very volatile quarter to quarter, but that core GDP increased at a healthy 2.6% rate in the fourth quarter and was up a total of 2.7% in all of 2023. But I think the best news that was that inflation came down below expectations. But it was still rising at 2.6%. That's a big improvement versus 6% that we've seen in the last couple of years. Does that mean that the risk of recession is past? Not quite. Not quite. I say to use a lot of adverbs there. But the money supply continues to decline in 2023. And in addition to an inverted yield curve, which we'll talk about in a second, this should eventually create an economic drag and pull growth down in 2024. Meanwhile, the surge in government purchases in the last year should soon abate as the federal deficit is on an unsustainable course. Of course, we've been saying that for the last 40 years, and they keep spending more and more money.
So what happens when money supply continues to go down, but personal consumption is going up so fast?
People are borrowing. They're putting money on credit cards and things like that. So we saw personal debt really begin to spike up in the last quarter of the year.
Mm-hmm.
So, it's the COVID stimulus is beginning to get depleted is why you're seeing that in the money supply.
You can see how the Fed is having a hard time right now. Mixed data.
Oh, yeah. I mean, I wouldn't want their job because it's very easy to mess up, and they're dealing with imperfect information, and the information that they're dealing with has a lag to it. So they're seeing things in the past and trying to predict what's going to happen in the future. I mean, it's a very hard decision process.
Yes.
No one really knows until after it's already happened. Okay.
So we mentioned sectors earlier, and we mentioned how the S&P 500 is back near record levels for the first time in 2 years. And technology is actually the only other sector that can say the same. So the S&P slightly up to start the year. Tech segment, the tech sector on its own is up even more than the S&P. But that means that there's 10 other sectors with an average gap of 15% below their all-time high.
Okay. All right. So there's still a lot of market loss to make up with that, right? Mm-hmm. So the market rally was much wider than 2 years ago in 2021. So
it's a different situation in 21. 7 sectors: industrials, financials, staples, real estate, healthcare, and utilities, and materials all joined tech at all-time highs.
But that was 2021 prior to the 2022, early 2022 highs.
Right. So I'm just pointing out a difference here of the sectors are not reaching their all-time highs.
Exactly. So a lot more room to go, as this article says.
Yes.
So with stocks, see, this is the thing. The media reports based on typically an index.
Right.
And so the S&P is at its all-time high. Actually, it's not right now.
It's not.
Below.
It fell.
It fell off in the last week or so. We're hoping that there's some support here, and we're going to begin to have the S&P build so it can have another leg up, and that would be a very positive sign. But it's a lot of it's been driven by cooling inflation, and that spurred investors to anticipate, as we said earlier, as many as 6 interest rate cuts this year. And those falling rates often boost share prices by reducing the relative appeal of bonds, making it cheaper for companies and consumers to borrow, lifting those corporate profits. But despite the record close, and it was actually last Friday that we had the last record close, the rally of major indexes has stalled in recent weeks. We've been moving sideways. The benchmark is up really less than 2% from what it was a month ago, while the labor market and the economy show few signs of slowing down.
That's that GDP data we were just saying.
So all this mixed data, bond yields have ticked up in the new year. Although in the last 3 days we saw on that chart, they've fallen a little bit. So this dynamic is prompting a lot of analysts and portfolio managers to warn that further stock gains might be halting because rate cuts are widely expected to power the market higher. They might not arrive as quickly as people think. And so the Russell 2000 gained a lot in the last 2 months of the year. And it's down, what do we say, 3%?
3.8,
3.8% as of the end of January. And so several other speculative stocks have taken a beating as well. And some of them losing more than 25%, rising during that Fed pivot rally that we had in December. You have to remember, the Fed changed its tune in December in the span of 2 weeks.
Yeah, remember those headlines we showed last time?
Yeah, because at the beginning of December, it was like, oh no, we're not gonna cut rates anytime soon. And then 2 weeks later, at their press conference, they started talking about, hey, we're setting the stage for rates cuts. What happened in those 2 weeks? Well, a lot of it had to do with we now have data to basically say that the Fed's very cautious. And what you're going to see in the next week and a half is you're going to see regional Fed presidents going around giving speeches at the local PTA or the economic club. I don't think they go to the PTA, but and talking about, and you'll see little nuances to further clarify what the statement they made yesterday was. So, there's things that you have to watch for, but still a lot more mixed data than we would like.
Yeah. Here's one more article I thought I'd throw in. The Federal Reserve facing so many problems that they'd love, right? They would love to see inflation falling faster than expected. But of course, this just adds to the conundrum.
But not too fast.
Not too fast.
Yeah. If inflation has sustainably, and we need more data, returned to that Fed's 2% target rate, then the real rates, which are like the nominal rates adjusted for inflation, have risen and might be restricting economic activity too much. This means that the Fed will have to cut interest rates. The question is when and by how much.
Yeah. And we know, of course, now that yesterday they held them steady, which doesn't give us any insight that we were hoping for.
Right. Okay.
Here's a new chart that I found, updated version of the comparison of the different cycles. The red line in bold, of course, is the one that we're in right now. That began in March of 2022. And it's just interesting to compare the lines, especially check out the orange line. That's on the bottom there. That's the 2015 cycle. That kind of snuck in there and not many people even knew it existed.
Right, because they were doing it gradually over a long period, over 3 years.
Right. So notice how dramatic the red line is compared to that. And it really explains why these investors are anxious for cuts as soon as possible.
Right. Okay, so we always show you, especially when we're in this type of economic cycle, we look at the Treasury yield as of the end of January, and it's relatively unchanged since our last market update. It's still an inverted curve. We like to see this curve looked opposite or flip it over on its axis. We like to see that it's still inverted. It started in March of 22. That means that for over 23 months, we've had this inverted yield curve. Now, just as a reminder, an inverted yield curve is historically proven to be a precursor to a recession. So every recession in the history of the United States, the yield curve has been inverted before that recession was recorded.
This time's different, right?
Yes.
That's what they say.
That's what they say, but we still think there will be some slowdown in 24. And will there be a recession? We don't know, because of all this mixed data.
Exactly.
If you start seeing employment falling and an unemployment rate rising, and you start seeing, more and more people losing their jobs, I would say we're probably going to be going into a mild recession.
Right. You'll see the 1 month yield around 5.5%. That's probably that's one of the highest that we've seen. The 30-year around 4.3. Those are opposite of what we'd like to see. The short term is higher than the long term. And the 10-year rate, that's closely related to the borrowing costs for American consumers. It's hovering around 3.95% right now.
Yeah. Okay. So how does this all impact you? With all this conflicting economic data and a rebounding market trying to predict a positive future, what does it all mean? Well, we don't have a crystal ball to tell you what's going to happen
I
tomorrow.
wish we did.
I wish we did. But we do know that these conditions have led to a recession every other time in the history of the U.S. economy. But we've got conflicting data. It's not clear cut. We don't know if this is going to continue this way. So let's have a little bit of a quick discussion of our strategy moving forward.
Well, these are the things that are really impacting people right now. So each one of these, you're probably feeling in your day-to-day consumption of goods. Inflation, although it's growing at a slower pace, it's still going up.
Right.
So everyday items are still expensive.
Right. And they're not coming down.
No. Interest rates are high, heavily impacting those of us looking to buy a home, car, other large purchase. But at the same time, your CD rates and your savings accounts are paying pretty good rates. So take advantage of that.
Yes.
Credit card debt is higher than we've seen in years.
I saw that credit card debt was above $1 trillion now.
Wow, that's huge. If you're struggling to use debt more than you need, we'd love to talk to you about that and not get caught up in credit card debt.
Yeah.
Personal money supply is low. You might feel this if your bank accounts are reducing. But the big one here is politics, and this is not a political show. We're not making recommendations, but it is important to talk about what's going on right now.
Well, and everybody wants to talk about it. And we get this I get the question every 2 years, whether, it's a congressional election, whatever it may be. This year, it's a presidential election.
Mm-hmm.
And for a lot of people, there's nobody exciting to vote for.
Yeah.
And so a lot of people will ask us questions like, well, they may have hesitation to invest in anything because of the fact that it's a presidential election.
Right. They think the party dictates market performance.
And we're here to tell you it does not. We have seen study after study that it does not matter who is in office. What matters is what's going on in the economy.
Right.
And there have been a number of studies. In fact, there was one that says if there's a Democrat in the office and then a Democrat wins re-election or a new Democrat wins the White House, that's positive. And if there's a Republican in office or whatever it may be, and a Republican wins the White House, that's positive. The people try to predict this, and there's a lot of commentary around it that, your choice for president is either going to wreck the economy or cause it to boom. And the reality is that most politicians can only hurt the economy.
Yeah.
Doesn't matter what party they're part of, and the president especially, they can impact the economy. Political parties love to take credit for something good, and of course they want to blame for something that happened, blame somebody else for something that happened bad.
That's how it works, right?
And that's what this graphic is up here from Bloomberg is like they're pointing at each other. I really love to see one of them bite the other one's finger off. That's about the only entertainment we're going to get this year, I think. And so, a lot of stuff is going on with Trump, a lot of stuff going on with Biden. We don't know who the candidates are going to be until the primaries in the summertime. But we've got a lot of data, a lot of research out there that shows that who wins the White House in at least the year after the election doesn't have a ton of impact, positive or negative, on the outcome of what the market performance will be in that year. There always is volatility the year of election because everybody's thinking that, right?
Right. They think that.
And it really doesn't make a big difference.
I think also mostly important to our listeners is our strategy does not change based on the political environment.
Exactly. Although I'm sure there's probably a fund out there that will
there are
invest in certain parties and what they're doing. But anyway, Jesse, go ahead and describe this chart.
So I told everybody that we'd check out a moderate index, and I'm not going to name it here, but it is that sort of moderate balanced type of investment. And it shows we use it as a benchmark.
Yeah.
And I added it because it explains why so many investors are feeling frustrated right now with their returns. You hear about the horrible news in 22, and then 2023 makes it seem like the rebound is back and bull market's back and everything's happy. Really, people were confused why their 401ks or other accounts have less value than they did several years ago. The bottom axis here starts in 2020. You can see the dramatic shift during COVID, the beginning of lockdowns there on the left side of the chart. The blue line horizontal is today's price, actually. And then I've drawn a vertical blue line at the back in time when the price was identical. And that date is actually September of 2020.
So almost 4 years, this index has had a lot of volatility, but it really hasn't gone anywhere.
Exactly.
I mean, we're talking about going back to the lost decade where the S&P for 13 years didn't go anywhere.
Yeah.
Except up and down, but never.
So far, it's not quite as bad as the lost decade, but many investors continue to be frustrated. And of course, if you're not working with an advisor who has a plan for how to navigate these markets, you're likely going to be sitting in a situation like this.
Yeah, exactly. Let's go ahead and talk about some of these past bear markets.
So just a refresher here, we like to talk about the time that it takes to get to a previous peak. And here's some historical data. There's all the way back to the Great Depression with the Dow Jones, 25 years. That's the biggest one. But let's talk about, for example, the 2007. Took 5.4 years to recover that 56% in the S&P.
Right.
And then the bottom row, the most recent data we have, November 2021 on the NASDAQ, minus 37.5%. And we haven't come back yet.
Yeah. So there's still much work to be done, and patience is required for any investor. But make sure that you are aware of whatever your financial advisor is doing, what's their tactic, and don't accept the notion of don't worry, it'll come back, because you need to take action on your portfolio to make sure that you're in the best things at the right time and that your portfolio is properly allocated to what's going on in the market.
Yeah, Mark and I would wager to say that you're not willing to wait 13 years to move anywhere.
Most investors don't have that type of tolerance.
Exactly.
Right. So
is that what you're willing to tolerate?
Right. So we prefer to manage your portfolio with technical analysis and active risk management. Now, there's no system on money management that's perfect, but we feel our approach helps us mitigate these losses and navigate through these volatile market cycles.
Right.
So, Jesse, what is the solution, right? We don't like the phrase here that this time is different, because we believe every situation can be found some similarities to the past, but it's often used to ignore current market and economic data that are flashing warning signs.
Exactly. Yeah.
So many folks are professionals and individual investors as well are just refusing to adapt to this reality. We're trying to adapt to this dramatic shift, and one reason why we choose to manage your investments with technical analysis and active risk management. So
we always encourage our listeners to avoid making panic decisions based on headlines, because the headlines will continue to be if it leads, it bleeds, right? If it's dramatic, they're going to post it. It feels so natural to make an irrational decision based on your emotion, but we do believe the future is bright. Artificial intelligence is a hot topic right now, but we do believe it has a lot of potential to make our lives easier and run more efficiently, but it's never going to replace the need for human beings.
No,
we're created to do more than that.
That's right. That's right. So some of you may be asking, what about my 401k? Maybe you're fully invested in a target date fund, or maybe you have no idea what your options are within your plan. If you have a 401k and would like guidance, please give us a call. We're excited about a new tool through one of our partner organizations that provides personalized advice based on your workplace plan.
Your specific plan.
Yes. And so everyone from large businesses with thousands of employees all the way down to small businesses with those 401ks, we have the ability to help you. And that service is something unique that we'd like to talk to you about. It's a very unique tool. We'd love to introduce it to you if you're currently still working and participating in your 401k. And it also just helps you understand all the options within the plan and provides a stop loss trigger in the event that a drastic market situation takes place. So as we always ask, we get into 2024, we encourage you to take action on your financial journey. We're always here for you. as always, you can give us a call. You can text us at 254-282-0495, or send us an email at info@ClearVista Financial. So if you have any questions at all about your portfolio or your financial plan, hopefully you have one. A lot of people we find don't have a plan. Give us a call. We love to just do that. And in a minute, we're going to have a survey at the end of the program today. Take that survey, give us some feedback. If you'd like for us to contact you to talk about some of these things or anything else that's on your mind financially, just check the box there and we'll be sure to get back with you in the near future.
If you're interested in that new 401k tool as well, let us know and we'll talk to you about it. We hope that today you learned something. We're really here to educate people so they can make their own decisions, and I hope it's been helpful. We'll check one more time for questions live, and while we're doing that, here's our contact information. A couple ways to get connected with us.
Yeah, and you can even schedule something on my calendar. I had one pop up the other day, Jesse. I'm like, who is this? Turned out it was my wife.
Oh, really?
Yeah, she used the Calendly app to schedule an appointment with me.
She has to go through your business calendar to get a time with you.
Then she later canceled the appointment, so I don't know what's up. So you can give us a call, that number there. You can always text us anytime, 254-282-0495. Until next time, folks, we appreciate you joining us today on the February ClearVista Financial Perspectives. Have a great day.